Welcome back, everyone. The stock market's headed towards the worst week we've had since March of 2023. Today alone, the Nasdaq's down 2.5%. The S&P 500 is down 1.76%. Even the Dow Jones is dropping. This has been a losing week for everyone. Over the past 5 days, the S&P 500 has dropped 3.6%, and the Nasdaq's now almost down 6% in 5 days. After years of the market being pushed higher and higher by large cap technology companies, ones like the Magnificent Seven, ones like big tech companies, it now seems like some investors are concerned that the rally can't continue with these stocks, that instead we need to look for returns elsewhere. We're now seeing a concerted effort from the media to push small cap stocks. The Wall Street Journal says why now may be the time to invest in small cap stocks. Bloomberg says that small caps rise as big tech takes a back seat. Barron says that small cap stocks are finally ready to run with the bulls. Is it finally time that we switch to small cap stocks? That we give up on the market leaders, the biggest and most powerful companies in the world? Well, in my opinion, no. That's not what I'm doing with my portfolio. I'm not shifting strategy from market leaders to small cap stocks. I own market dominant monopolistic companies that continue to grow through any environment. I believe the pressure the media is putting on investors to sell out of these companies because they've gone through a winning streak is misguided. But I understand when the market's being shaken and it's going down a bit, it becomes more difficult to hold on to companies that you were once bullish on. The thesis and conviction we have on these stocks is most tested during downturns. So I roundly reject the pressure from the mainstream media to abandon a well thought out strategy and to sell companies that have been long-term winners and compounding machines. I'm not going to sell out of what I believe are the most prized assets in the world and instead start favoring lower quality companies. But while I continue to stick to my strategy and focus on what I believe are the best companies in the world, I continue to review my holdings from time to time. And I believe with this market sell-off, now is as good of a time as any to review my holdings. So I put together a simple hedge fund style overview of every company I own. That's right, these are the bullet points, the investment case, the thesis of every stock I own and where they stand now. And yes, we're going to be reviewing every single one of them in this episode. So this is going to be a very informationally packed episode with lots of takeaways, and this one took a long time to prepare, so I hope you enjoy it. Now, before I jump into the thesis of each of these companies I own, I want to give a little background here. I've been building up this portfolio called the Passive Income Portfolio since 2017. It started off very small as just a couple $1,000s. As I continue to earn money, I put more and more into this portfolio. The combination of reinvested dividends, of new contributions through adding more money to the portfolio, and through capital appreciation has grown the portfolio dramatically over time. And this is what I recommend to anyone. Family, friends, and viewers. Start building up a portfolio. Start buying high quality assets. Use weakness in the market to add to positions you want to own. If you're not able to pick out stocks and you don't believe that's a skill set you can master, that's fine. Buy a high quality ETF like the S&P 500. In my case, I focus on a strategy of continually compounding my returns by buying what I believe are the best assets in the world. I call them compounding machines. I have an entire investing philosophy that outlines everything I do with my decisions, the specific type of attributes I look for in companies. I give illustrations and examples of what compounding machines are and what they aren't. I have a strong focus on the free cash flow companies generate over time. The more consistent and faster growing and predictably a company can generate free cash flow, the better. I have a strong focus on developing an investor temperament. That means that you are rational, logical in your decisions, consistent with your plan, and not making decisions based off of gambling or impulse. And I have guidelines on when I buy stocks and when I sell them. This entire presentation is given away for free. Anyone can download it, and I overview the entire presentation in the episode with this thumbnail. Invest Like Buffett. The episode title is How to Find Compounding Machines, a Full Guide. That's where I go over my entire investing philosophy. That episode now has 250,000 views with 99% thumbs up. So a lot of people enjoyed that one, going over the investing philosophy. And I believe this episode will be informational as well, going over the application of that philosophy. So having said that, let's go ahead and jump in and we'll look at the first category of companies. First on the list, we have S&P Global. This has grown into my largest position. It is currently a $105,000 position with $31,000 in the green. S&P Global has performed really well this year. Year to date, it's up 17%, not counting dividends, which beats the S&P 500 and the Nasdaq. If we look at an overview of what S&P Global is, what they do, it highlights why I love this company. First of all, they are a dominant credit rating and market data provider. Now, I go further into the credit rating business when I cover Moody's, but just to give a brief overview, ratings are a natural monopoly. That means that it's cheaper to be rated by S&P Global and Moody's than to go to a competitor, even if a competitor offered their services for free. Because when you're rated by S&P Global and Moody's, your debt has a lower interest rate. Investors will pay more for it because they have the comfort of that rating. Now, S&P Global is not just a ratings company. S&P Global has its hands in a lot of diversified, wide moat, high margin businesses. They have market intelligence. That's the market data portion of the business. Then they have ratings. Then they have commodity insights, mobility, and indices. All of these have varying degrees of their level of competitiveness, but they're overall very high margin concentrated industries. Nearly all the revenue is subscription or reoccurring. All these businesses are high margin, low capex, low advertising, low stock-based comp. Further, everything with this company has secular trends of growth. Debt issuance, passive investing, market data, all have long-term secular trends at their backs. So this company just needs to ride the wave, pushing them forward. They're already in the leadership position in these industries. They just need to go along with the secular trends. Now, they're also moving past a large acquisition. They recently bought a company called IHS Markit. That merger is allowing them to have predictable free cash flow per share. And now that most of the impact, the short-term troubles with the merger are behind them, we'll see even more predictable free cash flow per share growth in the future. And then ultimately, when I do analysis on different management teams and culture, they have a strong culture of efficiency, growth, and providing strong shareholder returns. It's not a flashy company. This isn't one that's going to show up on anyone's radar as being a really fun or exciting company, but they give strong shareholder returns. So S&P Global continues to occupy the top spot. The performance may vary over time, but right now this one has beat the market. Next up, we have Mastercard. This is another massive position, $91,000 in this single stock, with $18,600 of that being gains. Everyone's familiar with Mastercard. We've all used Visa Mastercard before, but most investors still don't fully understand the power of this network effect. Mastercard has a royalty or a license on the growth of other businesses. Warren Buffett himself has said that that is the best type of company, one that has a royalty on the growth of other businesses. Now, in the case of Mastercard, they don't just have a royalty on the growth of one particular business or one small segment. They have a royalty of the growth on many companies, millions of companies. It's almost a royalty on global growth. They have significant network moats through customers, merchants, and partner banks. And it's now so large, it's nearly impossible to break or impossible to usurp. There are multiple billions of Mastercards actively in the world today. One of the advantages of percentage-based revenue, where they take a sliver of every single charge, is that it works as a significant inflation hedge. So as global economies print money, as they devalue money and they cause inflation, Mastercard will naturally grow in part because of that inflation. So if you're concerned about inflation long term, this is a natural hedge. There's also the case where we still have currently trillions of dollars in cash that will eventually shift to digital. That's another big tailwind for this company. And it's very unlikely that government regulation will cause significant obstacle to their growth. They're going to be regulated. There's going to be price controls. There's going to be certain things that cause them to slow down. Mastercard is at a point where they're too developed, too big to be stopped. On one side of the business that investors are less familiar with, they have data gathered through their massive network and they repackage it and sell it as value-added services. So when you look at the revenue breakdown of Mastercard, a significant portion is from those value-added services. And I really like when companies are able to do this, when they're able to use one portion of business, the massive network they have, to aid another portion of business, which is the value-added services. So they are able to grow this portion of the business in part because of their network. Now, in terms of the moat and durability, I believe Mastercard has long-term predictability. It's unlikely to be disrupted. Many investors believe that crypto or different payment methods will disrupt Mastercard, but they've worked alongside many other competitors for a long period of time. So I believe it's very unlikely for Mastercard's long-term growth to be disrupted. Now, one of the best performing companies in my portfolio over the past 5 years is in the consumer category. It's normally a category that I don't invest in. I don't like physical retailers. In fact, I don't own any single physical retailer except Costco. I started buying Costco way back in 2018. I continued to buy it during any time it would dip, and I wish I had bought more of the company. Currently, it's a $76,000 position with $41,000 in the green. I tell people that I invest in the best companies in the world, and I believe that Costco is a good example of that. It is the preeminent physical retailer in the world, and I think that's by a good margin. There's no physical retailer that comes close in terms of business quality to Costco. They're first and foremost the only physical retailer that's been able to successfully pull off a subscription-based company at their scale. There's others that are trying to mimic the model, but to lesser degrees of success. Their subscription-based business has a 93% retention rate, which has increased over 2 decades. 93% retention rate is incredible. Seeing it go up over time as they open up new warehouses is even more incredible to see. Costco is not a seller of products. Now, this is where Costco gets misunderstood. Most retailers make money by selling products. They buy inventory, they mark it up, and they sell it, and that's their margin. Costco is not a seller of products. They don't consider themselves a seller of products. They are a buying agent on behalf of their membership. They use their large scale and their massive membership to broker better deals on behalf of their membership. Their goal is to have the lowest prices possible on different items. While most investor presentations of different companies show you how much they're able to charge for their premium products, Costco does just the opposite. They highlight deals and lower prices in their investor presentation. Members receive the best quality and lowest prices possible. That angle of business makes it incredibly difficult for competitors to compete. Costco's high-quality products, experienced staff, low margins, long-term customer trust is incredibly difficult to disrupt or compete against. This mixture of business qualities in a single company is so difficult for anyone to compete with. Now, the membership model also rules out bad customers, and it tilts towards high-income customers. In retail, one of the biggest problems are bad customers. There is a huge problem with theft in retail, people walking out with different items. The membership makes it very difficult to steal from Costco because if they catch you stealing, they'll revoke your membership. If your membership is revoked, you have a tougher time getting in the warehouse. So the membership model rules out bad customers that Costco doesn't want to have. And it also improves the shopping experience for every other customer. Now, the valuation is not cheap. That's the biggest problem with Costco right now. It's trading at a 54 PE ratio. But investors focus on the PE ratio intently year by year, whether it goes up from a 40 to a 50 or back down to a 35. The PE ratio jumps around from time to time. I'll admit that it's on the high side right now, and I'm not actively buying Costco. I always wait for a dip to buy this company. But I think one thing that should be the greater focus when entering into positions with a long-term focus is, can the business predictably grow for the next 25 to 30 years? When I do analysis over the different companies that I invest in, Costco is one of the most predictable on my list. In fact, I believe it's incredibly predictable to open up 25 to 30 new warehouses every year for 2 decades. Costco has a very deep bench management that builds Costco brands for the long term. They build it with care. They build it with caution. They've done so with their Kirkland Signature brand. Management also runs the company with an impeccable balance sheet. They take on no risk through long-term debt, and they have far more cash than their debt or their leases combined. So while I'm not actively buying Costco, I'm also not selling it. I continue to hold this company because of my favorable view of the future. Another company that's in a weaker industry that you wouldn't expect to be a compounding machine is in the restaurant category. I currently own a significant holding in Texas Roadhouse. This is now a $70,000 position with $35,000 in the green. What drew me to Texas Roadhouse was not only visibly seeing how good the execution was in the restaurant. As a patron myself, I thought that it was expertly ran. But it also started to catch my eye when I looked at the charts and the long-term history of the company. Very few companies have as steady of revenue growth as Texas Roadhouse. The number of restaurants opening every single quarter was also steady. Same-store sales also grew very steady throughout time. The earnings per share also grew with a great deal of predictability over different times. I was convinced that Texas Roadhouse was an underappreciated compounding machine, and I decided to invest in it during a dip. Now, when I look at the stock now, it's currently at a stock price of $160 and has a market cap of $11 billion. So it's gone up around double since when I first bought into it. But I still believe in a bright management for this company. First of all, Texas Roadhouse has an expertly structured and scaled steakhouse. And this is difficult to do. Restaurants at scale rely on processes. They need to have good incentive structure. Now, the unique management of Texas Roadhouse and the incentive structure resulted in a highly motivated local restaurant operators. If they continue to operate with this level of precision, the stock will do really well for a long period of time. And I don't see their operations changing for the worse. Now, they're also in an industry where they have competitors that are far higher priced to them. That has been a big advantage for Texas Roadhouse. They are affordable with their high quality steaks. And I believe affordable high quality steaks will always be in demand. We also see that GDP per capita has increased over the past decade, and any increase in GDP per capita is likely to increase spending on experiences. Texas Roadhouse falls into that category of experiences. When you have extra money, when you have discretionary spending, and you want to go out and have a fun time, restaurants become one of the primary places to do so. They're also at very large scale, which provides them with better cost structure and lower input costs. Even today, I estimate the runway for growth remains long with Texas Roadhouse. They're opening up new Texas Roadhouse locations every single quarter, new Bubba's 33, new Jaggers, and they all have room for growth both in the US and outside of the US. Texas Roadhouse also has growing takeout, which is now a $1 million per restaurant business. They're making around $20,000 a week in takeout. Now, they also have an incredibly strong balance sheet with no long-term debt. So while this company's growing and growing and growing, they're not doing so on a capital leverage basis. They have $200 million in cash with no long-term debt. They are slow and deliberate in rolling out new restaurants, which reduces the risk of the company. So Texas Roadhouse today is not the same still it was when I was buying it, but I still believe that there's ample upside for the stock, even though it's up 40% year to date. Now next we get back to the financial tech category, and we have Moody's Corporation. Moody's is the counterpart to S&P Global, but Moody's is even more concentrated in the ratings business. Remember how I said that Mastercard has a royalty on the growth of other companies? Well, Moody's has the same thing, just in a different way. They have a royalty, or they are a toll collector on global debt issuance. Companies use debt to grow, and anytime they issue debt, they're most likely going to get it rated by Moody's. There's currently $73 trillion of total debt that is rated and growing. Moody's, S&P Global, and Fitch combined rate more than 95% of global debt. Moody's and S&P Global both have around 40% market share. So these companies are duopoly toll collectors in this massive market. $73 trillion of debt being issued that needs to be issued and paid off over and over and over again. And again, Moody's enjoys a natural monopoly, as it's cheaper to issue debt rated by Moody's and S&P Global than free alternatives. The other side of Moody's business outside of their ratings is their analytics. This is a growing subscription business from selling proprietary data. Moody's uses their investor services business, which is their debt rating portion of the company. They package together the data and then they resell it to their Moody's Analytics, which is their subscription business. Moody's does the same thing that Mastercard is doing. Mastercard uses their network to get a lot of data, and then they sell value-added services. Well, Moody's does basically the same thing by using all the data they get through their debt rating business. They package all of that together, and then they sell it to companies through an analytics subscription business. That's called Moody's Analytics. Around half of what the analytics business uses is aided by the ratings business. So in a way, similar to how Mastercard works, Moody's is growing this subscription business on the side that's growing in part because of their monopoly business. Now, while all of this is going on, they have excellent cost structure, allowing the majority of cash to go directly to shareholders through buybacks and dividends. These elements of the huge moat of this company, the global nature of the business, and the cost structure have caused this one to be a long-term outperformer. And even this year, it's far outperforming the S&P 500 and the QQQ. It has 25% returns year to date, while the QQQ and S&P 500 are struggling to get half of that. Even though there is some overlap between Moody's and S&P Global, I'm happy to have that overlap. And I like that Moody's gives me a more pure play into the ratings business. Now, as we go throughout the portfolio, I get into some of the newer additions, companies that I've most recently bought. One of them is in the consumer category, and it's Booking Holdings, the owner of Booking.com. This is currently a $47,000 position and only $600 in the green. So it's teetering between the green and the red. There's a lot of questions of why you would buy a company like Booking Holdings when it appears like we're going into a recession. But even despite that fact that we may go into a recession someday, Booking remains a very attractive investment. First of all, it's the largest online travel agent in the world, and I love owning the top companies in their industry. They're over 4 times the size of the closest competitor in Europe, and Europe is a heavily traveled to place. So Europe's a very valuable market when it comes to the travel industry. Booking being the largest company there by over 4 times means that they're an extremely profitable company in Europe, and that's where the majority of their profits come from. Now, they also have diverse offerings of hotel, flights, taxis, cruises, and restaurants. The company's not just a hotel company. They're not just a flight company. They also do Airbnb. So Booking Holdings wants to be your one stop for planning your vacation. When customers realize they can do everything through Booking, they have little reason to turn anywhere else. Now, even though this company's been around for a long time, they've grown for decades, I still believe that there's significant room for growth in global online air and hotel bookings. There's still a lot of opportunities for them to grow across the globe, and more countries are growing their GDP per capita. That allows Booking to naturally grow. There's other secular trends pushing this company forward. Higher GDP per capita increases the likelihood to seek experiences over things. This is the same thesis I have with Texas Roadhouse. When people have more discretionary money to spend, they want to seek experiences. People typically don't want to buy their 3rd car or 4th car. They get the amount of transportation and goods that they need, then they seek experiences. So I see a long-term trend of GDP per capita increasing, and I think that will only benefit travel companies. They're also highly efficient in their cost structure. Most of the company's completely digital. The only big spend they have is with advertisement, and that's very flexible. This has allowed for rapid share count reduction. They direct all of their free cash flow back into buying back their shares. And since they have a very high free cash flow yield, a low valuation, they can do this effectively. The current valuation of the company is very undemanding. An 18 forward PE, a 6% free cash flow yield, is one of the cheaper companies with these type of characteristics. Another new holding that I've added to the portfolio recently is in the tech category. Right now, this is my only position that's currently in the red. It's Salesforce. When I look at the overview of Salesforce and my thesis on the company, I still believe today it offers one of the best risk rewards in the market. First of all, Salesforce is a dominant CRM platform. That means that they manage your customers for your business. They have over 150,000 people using the platform, different companies, which creates a large network effect and ecosystem. The massive customer base really benefits them with things like their App Exchange. They have lots of developers building apps in the Salesforce App Exchange. They also have exhaustive offerings of sales, service, marketing, and commerce, analytics and integration, and custom applications. The fact that they have such a comprehensive suite of software makes it very difficult for other would-be competitors to gain market share. They have extremely high switching costs. That means that once a company starts building upon Salesforce's platform, it becomes more and more difficult to move away. The biggest focus most recently for management is on building upon their cash flows. Their operating margins, for example, have gone from -8% in 2021 to +17% in 2024. So we've had a massive swing in operating margins. Their free cash flow per share growth rate has increased by 50% in a single year. So we're seeing massive increases in free cash flow per share growth. They're going to keep gaining operating margins and have their free cash flow grow with their organic revenue growth. The other part of Salesforce is the debate of how AI will impact the company. I have the belief that do-it-yourself AI models will eventually shift to large-scaled platforms. Most of those companies will eventually start to use a platform that already offers AI models and AI tools. Cloud started the same way. Cloud started as fragmented and eventually concentrated to the leaders. Now there's a couple top companies that control the big portion of cloud. I believe the same dynamic will happen in AI. Don't be mistaken by the stock price not responding to these earnings reports. That's normal with the market. Salesforce is growing their free cash flow per share. They're growing their revenue. They're reducing their share count. They're paying a dividend. If they continue on this track, it's inevitable that the stock will eventually move up. Now, if we move into one of the companies that I haven't talked about as much recently, but I've still held in my portfolio for a long time, we get into the real estate category. And we have VICI here, my only real estate company. The current position size is around $39,000 with $12,000 in the green. I would describe VICI as a highly predictable group of income-generating properties. They are long-term, multi-decade leases with contractual rent raises. That means that VICI has a very high predictability of being paid a certain amount of money every single year, and that amount of money should raise over time. These are profit center properties, which tenants cannot leave or relocate. A problem with investing in commercial real estate is there's always more office space down the street. And what if that office space offers you incentive to move your company from where you currently are to their location? Well, in the case of VICI, you avoid that problem. There's no Venetian down the street. There's no other MGM properties that the operators can move into. They are stuck in these properties. So VICI can charge their rents and not worry about their tenants moving to different locations. These are also triple net leases, which means that the majority of expenses are on the tenant. If anything unexpected happens, that's going to be a tenant cost, not VICI. VICI's also routinely grown their AFFO, which is like the free cash flow per share for a REIT. They've grown that every single year since 2017. Now, in terms of the macro environment, the reason that investors invest in VICI is they're seeking high yield investments. When interest rates go up to 5% and you can get treasuries for 5.5% or 6%, that means it's very difficult to want to buy a REIT that's offering you 7% with a level of risk. The spread between treasury rates and VICI impacts VICI's valuation. Interest rates falling should improve investor appetite for VICI's yield. If treasuries go back to 3% and VICI's yielding 7%, all of a sudden this stock becomes far more attractive. So I expect the stock price of $33 today to go up as interest rates fall. So VICI has been kind of a quiet holding in my portfolio. It hasn't really done much, but I remain bullish on the company. It's such a reliable, predictable company that pays me on schedule every single quarter and routinely raises its dividend. I like the predictability of it, I like the long-term nature of it, and I think it will do even better if interest rates go down. Now, if we look at the last company in the financial category, we have Intuit. Most investors know Intuit from their popular product TurboTax, which is not a fun product to begin with. Taxes in and of themselves are not fun, but Intuit happens to be a really good company. It is a very, very good tech company. It's a dominant, diversified financial software provider, concentrated market share of small business accounting and tax software. They're currently in transition from moving many of their customers from desktop one-time purchase to browser software as a service subscription based. This is the same type of transition that Microsoft did, that Adobe did, that had incredibly good results. Intuit's following their playbook, doing the same thing, and they're pulling it off really well. They're around 80% through that transition. Management of Intuit's also intently focused on enhancing the product suite with AI. They are adding artificial intelligence to everything they do to make the products better and better. There's also what I would call significant switching costs and network effects through the knowledge base of Intuit. A lot of accountants know how to use QuickBooks. In fact, they use QuickBooks for years and years. Because there's a massive knowledge base of using QuickBooks, it makes more accountants more likely to use QuickBooks in the future. Switching costs are because of knowledge base as well. And the same type of thing exists with TurboTax. If you do your taxes with TurboTax for a few years, your taxes become easier to do because TurboTax knows your history, therefore making it difficult to switch to competitors even if they're free or cheap. In most cases, most people would rather save the hassle and do their taxes with a platform they know will do it quickly and easily. They have a great balance sheet, moderate leverage with net debt to EBITDA less than 1 times. That's a mathematical way of saying that this company is not heavily indebted. They could pay off their debt within a single year. And they have a long proven history of dealing with competitors, overcoming free government options and outperforming the market. The free tax software has been tried before by the government and it never gained traction. Intuit's products are too well optimized and used by customers to see significant loss of market share. Ultimately, Intuit is a similar company as Booking or Salesforce. It's a scaled software company with incredibly attractive margins and it's super profitable. Now, if we go back to the tech category, I have a couple companies that have been obvious picks throughout history, Microsoft being one of them. I bought into this company heavily at $220 per share. Now it's raced up to $400. But looking at the overview of the company, I still believe Microsoft is worthy to have in the portfolio. It is an entrenched business tool leader in Fortune 500 and small businesses. Almost everyone's using Microsoft. When every company's using your business already, it makes further sales opportunities even better. Over 80% of revenue from Microsoft is subscription or contractual. So it's highly reoccurring revenue. They have bundles, network effects, switching costs, knowledge base. All of that works together to create a significant moat. The core business is so strong with Microsoft. The ecosystem works better together, creating an incentive to use Microsoft products over competitors. When you use things like Teams and you're already in the Office ecosystem, it's just a little bit easier to use other Office products. Azure is currently second place, and it's going to end up either second place or possibly first place if they can beat AWS. Now, there's a debate over whether or not they'll surpass AWS, but either way, they're going to be in a close first or second place in cloud, which is a very enviable position to be in. Cloud leadership will support earnings growth for a decade. The cloud market position is nearly impossible to disrupt. No one's going to come out of left field and steal their cloud leadership. AI product suite enhancements offer continued growth opportunity. They're already intermingling AI into all of their products. Again, Microsoft is a massive platform business. They have so many different pieces of software that they offer and that they can integrate AI into. They're spending a fortune on CapEx right now, but that should normalize over time as we go through this AI upgrade cycle. It'll eventually start to unwind. They'll better figure out how much they really need to invest in AI. So I don't expect this explosive growth in CapEx to be a permanent fixture. I'm not buying Microsoft right now. The company's trading at a full valuation, but I still think it's worth holding, and I'm going to continue to have it as a key position. Now we move on to one of the smaller positions in the portfolio, but it's still relatively large, which is Canadian Pacific. This is a $35,000 position. It's currently only $2,700 in the green, which is not a lot based on how long I've owned this company. It really hasn't performed so far. Even though it hasn't been a detriment, I like to see more from the companies I own. Aside from the lackluster stock performance, I look over this company and there's not much to complain about. In terms of the company's management, in terms of their fundamentals, everything looks really sound. Canadian Pacific is an advantaged Class 1 railway system spanning 3 countries. The rail network spans from Mexico across the US into Canada. That in and of itself is pretty unique and gives them a lot of advantages. Management is quickly optimizing through the merger. They recently did this merger to make that railway system. That incurs a lot of one-time expenses and headaches, but management is going through that. The CapEx and growth guidance that the management has given implies a 20% free cash flow per share growth rate. That's just the simple math. And this management is really good. They usually undershoot things. So they're not selling investors a bill of goods that they can't live up to. Railway systems are stagnant. They're unlikely to ever be recreated by any other system in the future. So the Class 1 railway systems we have are not going to change much over the next 20 years. Now, the experienced management is a part of this thesis. With railways, it's important who's running them. In this case, it's Keith Krill, who has a long history of outperforming market expectations and competitors through optimizing railroad operational performance. He is just really good at his job. He gets things on track, he does it well, he takes care of employees, he reduces the amount of accidents and risks, he optimizes all the routes, he does a good job all the way around. So Keith Krill is an excellent leader for a really advantaged company. When I look at the long-term nature of companies, this one has a reliable terminal value. I don't see much disruption in the future. There's the argument that driverless trucks could disrupt railways in the future, but I don't buy that argument. Trains already don't need drivers. They only have a couple operators per 100 plus cars. And railway systems and trains are already multiples more efficient than trucks. So anything that's really heavy or toxic or difficult to transport for hundreds of miles is going to be moved by trains. And I don't believe that's going to change anytime soon. Now, finally, we get to my now smallest position, which is Apple. It is now a $32,000 position, $30,100 in the green. This has been a wonderful performing holding, but I've recently been selling out of my position. When I look at an overview, there is still an ongoing thesis to have this company in the portfolio. Apple's a dominant hardware and software tech ecosystem. The iPhone is simply too powerful. And by what I see technology-wise, I don't see anything disrupting the smartphone. Every other possible disruptor so far has been vastly inferior. It's just too powerful of a device to disrupt. There's integrated services like iCloud, iMessage, FaceTime, and so on that maintains this massive network effect with Apple's ecosystem. They have incremental value creation through the integration of AI. We've already seen that they're going to enhance Siri with an AI Siri, and they're growing their default platform position with more and more active devices. That makes the default platform even more valuable. We've seen how much money that Google is able to cough up to pay Apple for that default position. So even though Apple has not come out with any revolutionary inventions over the past couple of years, it doesn't seem to matter. Their default platform and their ecosystem has held this company up and grown it. The network effects are so difficult for regulation to break up that at this point, I think it's nearly impossible. Steam, for example, Steam on the desktop maintains a 75% market share of PC games despite being outdated with its interface and lots of competitors with lower fees. The Epic Game Store, for example, only has a few games on it, even though it's cheaper and it's freely available for every desktop. The network effects keep gamers launching their games on Steam and buying their games on Steam. That's the power of network effects. Even when you have access to something else, seemingly, that's easy to use, people still use whatever's most popular. Now, I'm also impressed with Apple's capital structure, particularly that they're one of the big tech companies that's not spending a fortune on CapEx. While Microsoft, Google, Meta, all of these companies are pouring money into CapEx to build out huge server farms, Apple's spending that money on buybacks. They are rapidly reducing their share count, predictably growing their EPS. One of the most predictable ways you can grow earnings per share is by reducing that denominator through buying back shares. Now, the reduction in share count lowers the total cost of the dividend payout as well. When they have less shares outstanding, they don't need to pay out as much total in dividends, so they can further push their buybacks. So overall, even though right now I consider Apple a very mature company, and I don't see anything in the future that's too revolutionary, they're dabbling in robotics and a few other things, but right now the core of this company is a powerful platform that has an incredibly wide moat and can funnel money back into buybacks. That should be enough to continue to grow the stock price in the future. Now that concludes a basic overview of every company in my portfolio and my thesis behind them. If there's ones that you think are better than the companies in my portfolio, if there are better, higher quality compounding machines that offer really high expected returns, let me know what they are. I'll be looking over them and doing analysis on them. I'm always looking to improve the returns of this portfolio. But as of right now, I've been happy. That's all for this time. See you in the next one.